my name's Fred Pye. I'm the founder of 3IQ, and I'm also the founder of Canada SailGP team. And what we both do is SailGP embraces technology to take a traditional business and put it into the stratosphere and use technology to elevate what is a traditional sport into the next stage. That's what we do at 3IQ. We embrace technology to take technology into the financial services industry and take it to the next generation. SailGP and 3IQ share many of its beliefs. We believe in sustainability, a better planet. We believe in inclusion. We believe in diversity. But most importantly, we also believe in inspiration. And the inspiration of getting kids off the couch and onto the water to learn to sail is the same kind of inspiration we're trying to do to get the old folks off the couch and embrace blockchain, Bitcoin, and crypto for that generation. The next generation, we all get it. So what we're trying to do at 3IQ, for those of you who don't know, we were the ones that fought the big fight. We spent 5 years working with regulators to absolutely be able to bring digital assets into the regulated world. And that's what we've been working on. When we launched 3IQ, or when we launched the first Bitcoin fund in the world, regulated fund in the world, it was March of 2020. Well, what was that? D-Day of COVID. Our assets under management were zero. Within 12 months, 3IQ peaked at over $4.5 billion of digital assets under management. The fastest growing asset management firm from scratch ever in 12 months in this country. Having said that, we're obviously in the middle of a crypto winter. So 3IQ has sat back and said, what is our responsibility? What's our job here? Yes, we will launch product after product when the markets are ready for them. But right now, our responsibility is to educate that generation that's there now, the generation of the Canadian banks that won't embrace crypto. We've got to teach the generation of the pension funds that don't understand the diversity that they need, the diversification that they need, and how digital assets bring it to that. So in our job to educate, I want to welcome on stage for the first time in Canada with us is Mark Connors, the head of research for 3IQ, and he's gonna walk us through how do you marry economics, digital assets, and investments together. So thank you very much, Mark.
Thank you, Fred. Your mic? Oh, I got it now. Thanks, Fred. And everybody, thanks for the warm welcome. As Fred said, I joined 3IQ because I saw the problem in traditional finance. And we're going to roll through some slides here, which I invite everybody to ask us for the slides. We'd love to share them. As Fred said, we want to educate people on the problem in traditional finance, the remedy that is in digital assets, and then the urgency that's right here. So
obviously, I'm the Chief Compliance Officer and the UDP for 3IQ, so we have very important disclosures. You can read these, but understand we are not giving investment advice. We are providing good, solid information for everybody today. So Mark, let's just start off at that whole thing about current economics. Everybody's going, we print money, what happens?
Right. So when we print money, what we're trying to show is not just is it words, we're all on Twitter, but sometimes when you're in the weeds of watching those threads go by, you don't have the context for what happened from March 2020 to today. So I had worked with a colleague named Zoltan Pozar at Credit Suisse who had written something called Wartime Finance. And I read it, and I opted it into a broader theme piece, because what happened is a world war. It was on a disease, and it was not using arms yet initially, but the impact was the same. So what we're showing here are three concepts. The money supply in the US, M2. We're looking at equity market cap, the Wilshire 5000, which is a larger pool of equities besides the S&P. And we're looking at GDP. So essentially, we're looking at the real economy, GDP, against the financial economy. Wage earners versus asset owners. So stay with me, because that's where the distortion happened. But from 1971 to 2007, almost 40 years, they all grew at the same rate. Policy supported, it didn't overwhelm anything. Equities, the real economy, and money supply grew at about 8% on average, with some variability. That all changed in the global financial crisis. Policy became distorted. They created something called QT, quantitative easing. QT is on my mind. And money supply grew. Only equities reacted. The real economy didn't take on. The money was not invested in the economy. It was diverted into financial and hard assets. Assets grew, wages didn't. Fast forward to 2020, and the distortion just went crazy. The money supply grew 17% on average for 2 straight years. Shocker, equities responded in kind, and the real economy didn't. This is only going to continue. We are in what we call the monetary ratchet. It only moves one way.
What about the debt? What happens when the governments print money, and then what happens with it? What do we do with that?
So the money gets put into hard assets. It doesn't go into the real economy. And what we think is happening now, given that inflation has hit, asset inflation hit earlier. Now we're seeing it in CPI data, in consumables like groceries, obviously energy. But the Ukraine invasion, obviously, and the supply chain issues in China exacerbated that. So you have a whole bunch of factors, Fred. And the problem with the money supply, it's only going to continue because, as we see in our next slide, the debt load that we have now as a result of COVID and the '08 crisis, we haven't seen it since World War II. So they have to continue to either issue debt. The other option, like we saw in 2008, is do you want to have a credit default? The point is, you can't have a default right now because the government doesn't have the same type of demographics like it had in World War II. It doesn't have the same global opportunity where the Marshall Plan expanded and you looked at Bretton Woods accelerating global growth. We have the exact opposite. So just this slide, and there are 2 terms that I think, again, I stole from Ray Dalio because I'm a thief, but on the concept side, but I do give attribution. Debt is hard to change, and demographics are hard to change. So whenever you read something on Twitter or whenever you go into a meeting, say, okay, well, how does this deal with the aging population? Does this help it? And how does it deal with economics? Does it solve for the debt load? Those are 2 things that all policy people are trying to solve. That's why interest rates are not going higher. They can't. They would blow up all of G10. Interest rates will not go higher. They will cap at 4.5% and go lower. So Fred, that's what debt does.
And
it puts a cap on rates.
And then we look at the supply. What is the supply of different assets?
So we said that there's a problem. So no one likes to have someone continue to say there's a problem, but there's also a remedy. And we use Bitcoin here, and we know the merge is another topic. We heard our speakers earlier. But Bitcoin doesn't print more. Bitcoin prints less over time. So here we just overlaid the inflation rate or the disinflation rate of Bitcoin over time compared to the CPI of Canada and the US over time. And as we saw with the debt load, asset inflation is only going to continue. CPI may be addressed over time with subsidies. Asset inflation will not.
So when we have increasing demand for digital assets and we have reducing supply in assets such as Bitcoin, what does that look like in the price?
So this is the price, and we're looking at Bitcoin price, obviously in log form, as an exponential grower. That's how you look at it. So the upshot here is we can't even use a normal curve. I mean, if you price S&P in this or gold, you barely see any lift over the same period of time. So the upshot here is we're in crypto winter, but Bitcoin is in a position it's only been in 2.5% of the time. It's below the 200-week moving average. We still think that there's an opportunity because adoption's coming. And guys like me from traditional finance are rolling in because they know that the stock from their banks and that fiat will not pay them for the rest of their life. And unfortunately, we're living longer, so that's a problem.
So that's our job, is to work with institutions, work with the pension funds, work with the traditional asset managers, and embrace what we're doing. Is it working?
Yes. Surprisingly, not as fast as we like, but a lot faster than what's getting press. So what Fred was alluding to was, you know, if you go to the idea about how people work, we think about things, we say things, and then we do things. So thought, words, actions. So here we're doing the words. Companies over time have had to put in the 10Q their interest in digital assets. It's a legal requirement. They can't take an action unless they speak to it. So 2022 is through May, so annualized it's even greater than 2021, despite it being a crypto winter. So the companies are coming, they're doing the businesses, and they're adopting it on their treasury platform beyond the crypto native firms.
And then finally, it's aligning everything. We know in Canada we seem to be aligned, there's work to do, but what's going on in the rest of the world in terms of alignment?
So we call it alignment of interests here, and you know, the IRS came out earlier, but really March 9th of this year with the presidential executive order in the US, so I'm showing my tilt of research, followed up by Janet Yellen. In September, they're going to have a general meeting to present to the president the plan for the RFIA, the Responsible Financial Innovation. And we believe that that will sort of give a little boost to the Loomis-Gillibrand bill, but more importantly, stable coins. This is what I'm going to finish with. Stable coins give the Treasury a brand new buyer of their increasing debt load in a moment. It's like Narnia. She goes through the closet door, is in a new realm, and there's another 160 billion of Treasury buyers for her. So that's one of the alignment of interests, let alone the GDP they'll get from the new business segment, which some call the 12th sector of the S&P crypto. So I think, Fred, that was the...
So even though there's bumps in the road, what we're saying is the world is aligning behind digital assets, your early stages. I want to thank Mark for coming up from New York to speak with us. Certainly follow Mark at 3iq.ca. Follow SailGP Can. And remember, it's not too late. Thank you very much. I want to thank you all for attending and listening to us. We appreciate it. Thank you.